Today, Binance announces the wind down of the BUSD stablecoin. And Zack Shapiro, managing partner at the crypto-focused law firm Reigns, breaks down the landmark Grayscale ETF ruling. Welcome to CNBC's Crypto World. I'm Tanea McKeel. The crypto market is in the red today to wrap up August. By noon Eastern, Bitcoin slid back below $27,000, while Ether fell below $1,700. XRP, meanwhile, dipped to 52 cents. Let's talk about the top stories. Binance is pushing users to get rid of their BUSD. The company announced on Thursday that it will gradually cease support for the stablecoin by February of 2024. Users will no longer be able to borrow BUSD after September 6th or withdraw Binance pegged BUSD tokens on BNB Chain, Avalanche, Polygon, Tron, and Optimism. Binance also said it will gradually delist BUSD spot and margin trading pairs. The move comes after Paxos halted minting of new BUSD tokens back in February at the direction of the New York Department of Financial Services. That agency pointed to several unresolved issues around Paxos' relationship with Binance for the order. Next, the judge overseeing Sam Bankman-Fried's fraud case might be open to delaying the trial. Reuters reports that Judge Lewis Kaplan said he would consider delaying the October 3rd trial after SBF and his lawyers argued he didn't have enough time to review evidence with his limited internet access in jail. Judge Kaplan reportedly raised the idea of a 5-month delay if the defendant, in good conscience, needs a postponement. Finally, a federal judge pointed to the need for clearer regulation while throwing out a lawsuit against Uniswap. A court in the Southern District of New York dismissed the class action lawsuit against the DeFi platform, which claimed Uniswap violated U.S. securities law. And in that dismissal, Judge Faya said the court, quote, declines to stretch the federal securities law to cover the conduct alleged and concludes the plaintiff's concerns are better addressed by Congress than this court. The judge also said that the current state of crypto regulation leaves plaintiffs without recourse. Also in that opinion, Judge Faya listed ETH as a crypto commodity. All right, let's stick with recent crypto court rulings for our main story. Artalia Kaplan spoke with Zack Shapiro, managing partner at Reigns, a law firm with a focus on crypto, to discuss Grayscale's win against the SEC and Ripple's landmark victory over its native token XRP.
The DC Court of Appeals recently sided with Grayscale, which sued the regulator over its denial of a plan to convert the Grayscale Bitcoin Trust into an ETF. The court said the SEC failed to adequately explain why it approved the listing of two Bitcoin futures ETFs, but not Grayscale's proposed Bitcoin ETF. The court argued that the regulatory treatment was unlawful in the, quote, absence of a coherent explanation. What do you make of that ruling? What was your immediate reaction?
Yeah, so my immediate reaction is that this decision is remarkable in light of the really high bar that Grayscale's lawyers needed to meet. They needed to show that the SEC decision to deny the spot ETF was arbitrary and capricious, that they couldn't show any real reason why they could deny the Bitcoin spot ETF when they had previously allowed multiple Bitcoin futures settled ETFs.
Do you think we're now getting closer to the first spot Bitcoin ETF in the US?
I think so. So I think the first thing to understand is the reasoning that the DC Circuit had in its decision. So the thing that had been at issue here was the SEC's repeated decision to deny the approvals of Bitcoin spot ETFs, arguing that the surveillance sharing agreements, which are agreements meant to prevent fraud and manipulation of the underlying markets, were insufficient. And the thing at issue is whether the surveillance agreement, which was the same between the proposed spot ETF and the approved futures ETFs of the CME, the Chicago futures market, was sufficient, and specifically whether that market met the two legal requirements you need to be of sufficient size. So first, in order to be of sufficient size, the market in question needs to be the place that someone who would likely manipulate the market in an unfair way would go in order to do that manipulation. The SEC had said that in terms of the spot ETF, manipulation could happen outside of the CME because you could just go to spot exchanges like Binance or Coinbase. But in the futures ETF, that was not the case. The DC Circuit said that that was not a reasonable justification because the spot market and the futures market trade 99.9% the same. And then the other argument the SEC had made was that the futures ETFs would not be a significant factor in moving the CME price, the market that's being surveilled, whereas a spot ETF really could move the underlying price of the CME given the size of the amount of Bitcoin that Grayscale holds. And again, the DC Circuit rejected that, saying that first of all, Grayscale doesn't hold any futures, so it can't directly influence the futures market. And any manipulation using a spot ETF would have to go through the spot market itself. And Grayscale only holds about 3% of the outstanding spot market for Bitcoin.
Let's talk about another recent court decision. A judge ruled in July that Ripple did not violate securities laws when issuing XRP to retail investors. The SEC is looking to appeal that ruling. Last month, you wrote a piece on that landmark summary judgment decision explaining what it means for the future of digital asset regulation. In the piece, you note that the judge concluded that Ripple's XRP tokens aren't inherently securities, but that the manner in which these tokens were sold constituted an illegal, unregistered securities offering in certain instances and not others. Can you elaborate on that and take us through the implications of this ruling?
Absolutely. So the 800-pound gorilla in the room of the crypto industry right now is the question about which of the crypto assets or digital assets, when they're offered and sold, constitute a type of security called an investment contract. So there are a couple of different types of securities, some of which are very familiar to people: stocks, right, which are equity securities; bonds, which are debt securities; and other contractual securities like options. But there's this other catch-all category of securities called investment contracts that rely on an 80-year-old Supreme Court case called Howey. And there's this framework called the Howey test that asks 4 questions. Did an investor invest money in an asset in question? Was that investment in a common enterprise, meaning did investors pool money towards some outcome? Third, did they buy it in the expectation that they would profit from that investment, from the thing they bought? And fourth, was that expectation they would profit based on efforts, business efforts, that the person who sold it or some other particular group would take, so not their own efforts. And here with XRP, most legal commentators, I think, had assumed that the SEC would win this case and say most people who bought XRP, whether in the initial sale of XRP by Ripple Labs or on the secondary market, were buying it to expect to make money on XRP. They wanted the price of the token to go up, and their expectations that the price of the token would go up would be based on work that Ripple Labs would do, for example, to make banks integrate this into their payment systems. And the court found that because Ripple Labs didn't make specific promises to retail purchasers of the token, that the sales of those sales to those retail purchasers didn't constitute investment contracts under this Howey analysis we just talked about. And moreover, that when Ripple Labs granted tokens to their employees and contractors in payment for services, that because those contractors and employees didn't pay money for the tokens, they didn't meet that first Howey prong of investment of money.
So late last month, a federal judge in New York split with the judge in the Ripple case, allowing the SEC to proceed with its case against Terraform Labs and its founder, Do Kwon. What does that signify, and what do you think that means for the industry? Do you think that decision adds to the uncertainty over crypto regulation here in the US?
Yeah, so like I mentioned, I think the Ripple case was a really big surprise to lawyers and commentators in the area. The more recent summary judgment ruling by Judge Rakoff, who's one of the more famous judges in the Southern District of New York, where both of these cases are taking place, I think is the much more traditional understanding of how securities laws apply to crypto, right? He said, just because something is not positioned as a security doesn't mean that in a particular context, it doesn't qualify as an investment contract. And so immediately what this means is that both of these cases are going to have to be settled by the Second Circuit, which is the Court of Appeals that oversees the Southern District of New York. And we're likely to get an appeals ruling deciding which of these two interpretations of the law is correct.
It certainly will be interesting to see what happens there. But what could the Ripple decision mean for those lawsuits the SEC brought against Binance and Coinbase? Do you think it could strengthen the case of those two major crypto exchanges?
So if the decision in the Ripple case withstands appeal, which I think is a big if, then absolutely it will strengthen the case that both Coinbase and Binance have when the SEC is going after them. The SEC is saying that both Coinbase and Binance are violating the law by hosting assets on their exchange that legally qualify as securities under the Howey test for the same reasons why the SEC thought XRP was a security. And if the reasoning that the Southern District applied in the XRP case is used in the Coinbase and Binance suits, then Coinbase and Binance will have much stronger defenses that the tokens on their platform do not qualify as securities, and thus they are not breaking the law.
In general, what's your take on the SEC's approach of regulation by enforcement? Do you think that's an effective approach for regulating the industry, or do you think there's a better way?
Honestly, I have a lot of sympathy for both sides here. On the one hand, I think that the SEC statements by Gary Gensler are largely true, that much of crypto is violating the laws, and a lot of these things do legally constitute investment contract securities, and they're flouting SEC regulations that other industries have to follow. On the other hand, the SEC, I think, is also playing hide the ball with how can crypto companies comply with the laws. There's not a straightforward path to register as a security. There's not infrastructure for crypto securities. And the SEC doesn't seem very interested in providing clear rules about how issuers of tokens can release tokens that do not meet the definition of an investment contract. So it's definitely true that the SEC has a lot they could go after, but this policy of regulation by enforcement, by instead of publishing clear rules or even its interpretation of the rules that exist, the SEC is just bringing cases on a one-by-one basis. That's a really tough thing for the industry, and a lot of frustration there about that.
Shapiro also weighs in on the main factors preventing mass adoption of digital assets and explains how U.S. courts are navigating the nascent crypto industry. You can check out his full interview at cnbc.com/cryptoworld. Okay, that's all for Crypto World today. We'll be back again tomorrow. We'll see you then.